revisit the basics of salary taxation. When this topic was first conceived and discussed within Team KSCA, there was a doubt in the minds of all as to whether there is a need for a session on such an elementary topic. But today, the highest ever enrollment and attendance in the last 1 year has dispelled all our doubts. Salary taxation is one area of tax laws which most of us have not revisited post our CA intermediate. Our application of tax laws in this area has largely been driven by common market practices, and in this process, a lot of errors and misconceptions have crept into our practice. Today's session is aimed at helping us getting our basics right, and at the same time also help us understand and gain practical tips on new age tax planning tools. To lead us through with the knowledge enlightenment, we have with us CSC Sumeet Khurana. On behalf of entire team KSCA and all the attendees, I welcome you, sir.
Thank you.
Let me complete a brief introduction of the speaker before we transfer the proceedings to him. Mr. Sumeet Khurana is a chartered accountant and holds a law degree. He is a tax litigator and advisor, assisting clients in handling ongoing tax disputes and developing strategies for avoiding potential ones. He carries a rich experience of almost 2 decades in handling tax advisory and litigation. Above all, a very humble person, in my opinion. In person, I am aware of a lot more accomplishments which deserve a part in this introduction, but it is the speaker's desire to be introduced in not more than 2 lines. So, with this very modest introduction, over to you, sir.
Thank you so much, Deepak ji, for inviting me here, and thank you for the Karnataka State Chartered Accountant Association for inviting me. Deepak ji pulled me into this. He said, Sumit, we have to do some session on this. That's why I'm here today. Like most of my professional brothers and sisters, even I do not take detailed examination of salary taxation on a routine basis. We've done some extra efforts in trying to brush up our skills on this. So we'll just share whatever little we have gathered and we'll see how it goes. So with that note, I start my presentation. I hope my screen is visible.
It is very much visible, sir.
So, dear friends, how we have designed this today's presentation is we have taken certain fact situations, and then we will take a look at the relevant legal provisions and apply the provisions and then see what the outcome should be. So I'm not with the help of Deepak ji, all these case studies have been designed. So we have not kept it academic in terms of only discussing the legal propositions or the points, but practical regular kind of experiences what we see, those case studies we have captured. So the first issue I'm taking is an excursion or an annual day celebration or any event celebration which occasionally most of the corporates do at least once a year or so. So taking the hypothetical facts, this is the facts of the case. Say Fun Tour Limited is a company which takes its employees for a pleasure trip annually, say for 2 nights, 3 days in a resort in the outskirts of the city. And say on day one, there will be few hours, maybe 2-3 hours spent on team building activities, some corporate training entities engaged, which will make the employees play some games, which will kind of enhance their skill on team bonding and mixing up with each other. And then employees will be made to stay, will be allotted rooms in the resort based on their cadre. It involves again huge expenditure and the rental accommodation. Food and beverages will be breakfast, lunch, dinner, and alcohol liquor in the night. DJ is arranged in the evening for gala night, and there is a guided tours for sightseeing in the around vicinity. So the question arises that is it a business trip or does it constitute perquisite in the hands of employees? Now, I know this question itself is a little troublesome. People will say we are whole year we keep on working hard, and when the employer gives us an opportunity to have fun, you want to tax us. And on the Friday evening, you talk about excursion, and then you say we'll tax it. It's again more troublesome. But whatever it may be, let us take a look at what technically should be the answer to this? What does the law say on this? So if at all it is a perquisite, what kind of amount should be included in the taxable income of the perquisite? That's the ultimate question. If you take a look at the rules, the relevant provisions, Rule 3, Sub-Rule 7, it says that the value of traveling, touring, accommodation, or any other expense which is paid for or reimbursed by the employer for any holiday availed by employee is perquisite. And the expenditure, whatever the expenditure is, the value of the perquisite. Now, on the first blush, it will appear that you're taking the employees for an excursion. It is a pleasure trip. The traveling and accommodation cost is perquisite. But let us not reach to any conclusion as now. We are taking a look at the provision only. There's a proviso to this clause. The proviso says, suppose the tour was official, but the official tour is extended as a vacation. Then the value of the fringe benefit will be limited to expenses in relation to extended period of stay on vacation. So as I took in my example, on day one, first 2-3 hours are spent on team building activities. So there is definitely a business element in that, because the employees, when they better bond with each other, it increases the harmony in the function, and it is for better business functioning of the company. So therefore, there's a business element. But the proviso says if the tour is extended beyond that, then extension is a non-business. It can tantamount to perquisite. But this first sub-rule talks about travel accommodation only. There is a sub-rule 3, which is relevant here. It says that value of the food and non-alcoholic beverage provided by employer to employee, that is also perquisite. The expenditure incurred by the employer on that is the taxable perquisite in the hands of the employee. There is a proviso to this sub-rule also, which says that if you incur these expenses in office, that is excluded. We will deal in detail with the proviso, but in office is separate, outside office is taxable perquisite definitely. Now there is a residuary rule. Residuary rule is rule 11 of rule 37, sub-rule 11, sub-rule 9, sorry, sub-rule 9 at the bottom of your screens. It says any other benefit or perquisite, value of that is cost incurred by the employer. So we have one sub-rule for accommodation, travel, etc. One sub-rule for food and non-alcoholic beverage. And then there is a residuary clause. Then we will see how does these rules apply in the context of the case study we had in our mind. Now this, my colleague who assisted me in providing this, putting up these slides, is he put this interesting caption: food for thought or thought of food. Now, if you see, there is this sub-rule 3, which talks about food, is differently worded from the sub-rule 2, which provides the, which deals with the perquisite valuation of the accommodation. If you see the perquisite value of accommodation, which is the first item on your slide screens, I am repeating it for the sake of, because it's important to notice that thing. It says cost of touring, traveling, etc. for any holiday availed. That's the phrase I have underlined also. So what is the significance of this phrase holiday availed? We thought of and debated about this. What is the significance of word holiday? It is only when this travel and accommodation, etc., is accompanied by a holiday availed by the employee that becomes a perquisite. So one school of thought emerged that if you're taking your employees on a weekend, say the pleasure trip is for Saturday and Sunday, which are in any case a holiday, would you say that you're taking them by and they are availing a holiday? That's in any case a holiday. And only if you take them on a Monday, Tuesday, or working day, that will tantamount to spending on travel, etc., where the employee avails a holiday. Other school of thought was that the word holiday, if you see in the sub-rule, it is accompanied by a word vacation. when the proviso talks about extended stay beyond the business purposes, it uses the word vacation. If you read these two words together, a meaning emerges that if the tour and travel and the accommodation, etc., was meant for a non-business purpose, that is the meaning of kind of holiday. Holiday means and a break from the work. So in that sense, whether you take your employees on any day of the week, insofar as it is a vacation from the work and a kind of a break from the work, it will tantamount to availing a holiday. Now, as I was emphasizing, there is a difference between the clause relating to tour and clause relating to food. In the tour related clause, it says these expenses for a holiday availed, but in the food related clause, the word holiday availed is missing, which gives an impression that you offer free food and non-alcoholic beverages to employees, even if they are availing a holiday or they are in the business tour, both will be taxable as a perquisite. So that's the kind of impression I get when I compare clause 2 and clause 3 when the absence of word holiday. Now, if you see, the focus is on the food and non-alcoholic beverages. So what is the significance of alcohol not being mentioned? And in our case study, we have said that there is alcoholic liquor is also served. So that's also forms part of a significant portion of the cost. So given that, what should be the tax treatment of that? On the last item on your slide is value of any other benefit is cost incurred. The question is whether the alcoholic beverage cost will fall into residuary clause and the cost incurred on that will also be perquisite. Now, how do we go about understanding this? So now the discussion is revolving about alcohol on a Friday evening. I don't take as on a personal note, I can tell you, but it is only from the tax perspective we are looking at it. If you see the common meaning of the word perquisite, what does perquisite actually mean? What are the parameters on which would you say that particular cost incurred by the employer tantamounts to perquisite in the hands of an employee? What are the features of that? Conceptually and judicially, it has been held to be a casual emolument, which is in addition to the regular salary, which is convertible into money. That's a very important ingredient of this. The first case known on this subject is Tennant versus Smith, House of Lords judgment. In Tennant versus Smith, the employer gave a rent-free accommodation to his employee. The question was whether an estimated rental value of the property should be taxed as a perquisite in the hands of the employee. The court held the perquisite should be ideally something which is convertible into money. This person can either stay there or not stay there. He doesn't have an option to make monetary advantage out of it. Therefore, this is not taxable as a perquisite, as was held in Tennant versus Smith. On a similar note, in the judgment of Gujarat High Court in the case of Acharya D.V. Pandey, again, the items given in kind were held to be non-convertible into money and therefore not perquisite. See, income in kind is taxable, but there can be a situation where it's not convertible only. Now, if the employer is taking employees on a pleasure trip, either they can enjoy or they can abstain themselves from going. But they cannot make it as a monetary advantage by converting into money. They cannot transfer this opportunity to some friend and make money out of it. No, that's not possible. So therefore, conceptually, this pleasure trip does not fall into definition of perquisite. But what has happened is, over a period of number of years, the legislature has enacted provisions specifically by artificially including in the definition of perquisite various items. For example, rent-free accommodation is specifically provided to perquisite. Now, once legislature specifically enacts something, then that will definitely constitute perquisite, but the common meaning will be applicable only to when there is no specific enactment. Now, if you contrast this situation with Section 28, Clause 4, which has been in a lot of talks because of introduction of Section 194R also, that there, if you see 28.4 says benefit or perquisite whether or not convertible into money, which again emphasizes that fact that Section 17.2, when it talks about perquisite, without attaching the phrase whether convertible into money or not, only those perquisites will get taxed under Section 17 which are convertible into money, but for certain specific entries. For example, house rent, rent-free accommodation, specific entry is there in Section 17. Even if it is not convertible into money, it is taxable. Then there is Section 17.2 gives a residuary clause. It says any other benefit or perquisite as may be prescribed. It is prescribed in Rule 3. Rule 3 again mentions certain items. Travel accommodation is mentioned, food is mentioned, non-alcoholic beverage is mentioned. Then what remains is the residuary category. According to my understanding of the law, the residuary category will be interpreted in the light of the judicially evolved concept, because there is no alteration by the legislation. So in the common parlance meaning of the word, or the statute, the judicial meaning of the word, the residuary entry would contain only those kind of perquisites which are convertible to money. So therefore, essentially what will happen is alcoholic beverage not specifically written anywhere in the special rules, and residuary categories incapable of taxing that. That's the conclusion we can arrive at by looking into the scheme of the law. So to sum up, it gives a very strange kind of a conclusion, but that is what we come up with when we technically evaluate the things. Travel and accommodation will be exempt from perquisite valuation to the extent it is for business purpose. Food and non-alcoholic beverages are taxable, even though it is for business purpose, though practically we see it is being conducted differently. If there are business conferences and stay and accommodation, nothing is offered to tax in practice, and that is being accepted by department because they have much more important things to probably attack on. This is but technically my understanding is, the way law reads is, there is a significant red area in that it is taxable according to me. Alcohol is the most luckiest element in this, because the way I understand law is they have failed to provide for it, and residuary category will be interpreted in the light of the judicially evolved meaning, which will not cover anything not convertible to money. So people like me are not happy, and those who consume and enjoy are the happier ones. So then the smaller item, there is a common practice of giving food coupons. We'll deal with that also. So tea and snacks are provided in the office premises. There's specific clause in Rule 3 which says they are not taxable at all, irrespective of quantum spent on that. As we noticed, if food and non-alcoholic beverages are served during office hours and in office premises, so dual condition has to be met. First, it should be during office hours, and then it should be in office or business premises, and value per meal is up to 50 rupees per meal. Then it is taken out from the ambit of perquisite. As far as paid vouchers, the coupons, or what Sodexo kind of gift coupons, vouchers, the meal coupons, if they are non-transferable and usable only at eating joints, again the value of 50 rupees per meal, that is also exempt. In a remote area and offshore installation, law provides that if it's a situation like that, then whatever is provided during office premises is fully exempt. Unlike if it is within the city area, then it is 50 rupees per meal. But if it's a remote area of your installation, then the food cost and non-alcoholic beverage fully exempt. Then again, in certain places, what we come across is a person may be receiving what is house rent allowance, and house rent allowance is meant for meeting cost of rental accommodation. The person may be incurring rental cost not for one accommodation but for two accommodation. Taking a situation, say there is a person, Mr. A, who's an employee of a company, and he stays in a rented accommodation in the city where he works, and for 2 days in a week he goes to his real native place nearby, where he also maintains another rented accommodation and stays for 2 days there and 3 days in the rented accommodation near the office. So whether he can claim rentals for both the accommodations, that's a question we sometimes come across with. If we see the law regarding this, section 1013A read with rule 2A, it says rent which is deductible is in respect of a residential accommodation occupied by the employee. Now, per se, the word residential accommodation, if you see general clauses at section 13.2 says singular includes plural and vice versa. So the reference may be to rental accommodation. It may indicate a singularity, but as per the General Clause Act, it will include plural. So it may be more than one residential accommodation is the impression we get or the interpretation we can arrive at by referring to General Clause Act. The other sting attached is it should be occupied by the employee. Can we say that the employee is occupying two rental accommodations? Of course, he's occupying for part of the week one and for the part of the week another one. But is that in conformity with the intent of the law? We get an impression again if you read section 23, which is though in the context of house rent, the income from house property. Section 23.2 read with section 23.4. The conjoint reading of that gives an impression that it is very much possible for a person to occupy multiple accommodations at the same time. If you stay in one accommodation for a few days, or people maintain multiple house properties in say areas where they visit occasionally for touring. So in such case, it is understood to be, or it is interpreted to be that he's occupying both the rental accommodation. So in nutshell, we don't see any challenge in claiming HRA exemption for both the residential accommodations. Again, a common practice, somebody may call it is a practice, some may want to say it's a malpractice or something else. But if an individual pays rent to his relatives, then what is the legal position? Will he get exemption of section 13A on account of house rent allowance? Say Mr. A stays with his family in a house which is owned by his father. Can Mr. A claim HRA benefits of the rent paid to father? Will the situation be different if rent is paid to mother or wife? No. It is a common practice in various communities to pay rent to parents for various reasons, historical. But so therefore, we can demonstrate that there is nothing wrong in it. It's a house which has been owned by the father because of and spending his own money into this, and he can rightfully demand a compensation for that after the child has started earning money. But there is I'm not aware of a common practice, at least, of rent being paid to wife or mother. So the question is whether that would be dealt with different. If you on ground, what we have seen is in some cases, the tax officers, they tend to question and deny the benefit that rent paid to family members, especially wife and mother, is seen with a different lens. Technically examining, what all we need to see is whether the family member is the true legal owner in the eyes of the real estate law as well as the income tax law. It should not be a case that the individual trying to take benefit of HRA exemption is the deemed owner under section 27. For example, if a person, an individual, if he gifts house property to his spouse or her spouse, then that individual continues to be owner in the eyes of income tax law. So such a deemed owner, if he pays rent, it will be like paying rent to oneself. Another element to be seen is whether wife has, for example, used her own funds to purchase the house. Because under section 64, if the husband has actually funded the cost of the house, then even though legal title may be in the name of wife, but clubbing of the income will be in the hands of the husband. So in such a case also, income tax law will essentially treat it to be his own house. So therefore, in those such cases, it may not be right to claim HRA exemption, but if it can be demonstrated that cost of the house is borne by wife, then there should technically not be any issue. Now, another interesting illustration we came across is whether the question here is whether the calculation of HRA benefit should be done on a monthly basis or on an annual basis. In certain cases, it becomes a little important. For example, in this facts, say Mr. A from Bangalore joins a company in Delhi in April. For first 2-3 months, he stays with friends or relatives, and afterwards he shifts into a rented accommodation. The question is, though he has earned HRA for first 2-3 months when he was not actually spending rent, so should that HRA also be aggregated with the rest of the months, and on an aggregate annual basis should we compute the HRA deduction, or should do it on a monthly basis? A accompanied question is, what if the rent or salary gets revised in between? Whether in such a case the calculation should be done for the period in which the salary or the rent was differential. Now we analyze this, and what we felt is there are two ways of looking at things. One approach is, because salary is payment of salary is a monthly exercise, deduction of TDS is monthly exercise. So the computation of HRA exemption should also be a monthly exercise. That is one school of thought which emerged, and which is supported by some textbooks also. But in my humble view, it's an annual exercise. Tax computation is an annual exercise. Even though TDS on salary is a monthly exercise, it is computed qua estimated annual income. Section 192 clear on that. It is estimated annual income on which TDS is computed. So deduction is a monthly exercise. So therefore, in my view, it should be computed on an aggregate for the whole year. But an important element to see here is Rule 2A. Rule 2A, which tells exactly the manner of computation of HRA exemption, is that rule says you have to compute it for the relevant period. The phrase used is relevant period, and the relevant period is defined to mean the period for which the relevant property is occupied, the rented house is occupied. Considering that, I feel since he has occupied this, in this particular case, the rented accommodation was occupied from June onwards. So the HRA for first 2 months will be fully taxable, and from June onwards till 31st March, there will be a separate computation for HRA exemption calculation. So an inference from that is, if you during the year, if you change your accommodation, simply change in rent is not enough. If you change the accommodation itself, then for that relevant block period, you will have a separate calculation. And this interpretation is supported by a Mumbai tribunal judgment. In very interesting case, the assessee stayed in a hotel accommodation for a few months and in an ordinary residential accommodation for the rest of the months. There, the court has held that two separate computations have to be performed. So, in my humble view, simply change in salary or rental quantum is not going to lead to a multiple computation. It is only when the accommodation itself changes, you will have a computation for two block periods or multiple block periods. Again, there can be a question around whether if somebody owns a house, can he parallelly claim benefit from HRA? We come across this question very often. What happens is, for example, in this case, Mr. A owns a house in Mysore and claims 80C and 24 section benefits in respect of the housing loan repayment, but he works in Bangalore and where he is staying in a rented accommodation. Can he claim rent on rent reduction on the rent paid? So the only condition which is there in Rule 2 and section is that the premises, the building which is which the rent is paid, that should not be owned. Ownership of any other building is not relevant. One cannot own the building and pay rent to oneself. That's obviously not possible. So that's the only prohibition. You should not be owner of the house. You can be owner of any other number of houses. That's not an embargo. Now we saw this next case study in especially during the COVID period. Many employers funded in different fashions the cost of the infrastructure when the employees were supposed to work from their home. So if the employer funds for purchase of say modem, chair, desk, table, the necessary infrastructure to work from home, whether this is a taxable perquisite. Now there are multiple aspects to be seen according to me in this. In some cases, the employers have simply given monetary benefit. They have simply given a lump sum ad hoc amount for employees to spend for the necessary infrastructure without there being any necessity to submit any proof of that, which is a simple and straight case of payment of salary. There is no doubt about that. It will be taxable as salary. If the money is given, therefore there is no question. But if the asset is given, then the question arises: who is the owner of the asset? Is the employee becoming owner of the asset, or employer become the owner of the asset? If the employee has been gifted the asset kind of, then the taxability arises under Rule 3, Sub-Rule 7, Sub-Clauses 7 and 8. We will have a separate case study. We'll dive deep into these two sub-rules and clauses. But prima facie, suffice to say that transfer of the asset, of any movable asset, is taxable perquisite. Now, there are multiple provisions in law pertaining to taxability of travel-related expenses. At some time, what is essentially required is to have a clarity of what are the various things covered in which clause. Section 10, clause 14, it confers exemption for allowances spent in relation to office duties, and the relevant allowances and the corresponding expenditures are spelled out in Rule 2BB. Rule 2BB deals with different kind of entries. It provides different entries for travel and conveyance related expenses. One subclause talks about cost of travel on either tour or transfer. So cost of travel would be the, for example, the airfare or the railway fare or the taxi cost on tour to maybe another location where there is the business necessity to visit, or on transfer. So the employee working from one location is transferred to another location. The cost of travel and tour, including the transportation of the household goods which he has to take along with him, that cost, any allowance given for that, is not taxable to the extent actually incurred on those things. And then there's a clause B, which deals with exemption of the allowance for meeting daily ordinary charges while he's on tour or in relation to transfer, which will typically cover his food and clothing, washing, etc. And then there is one sub rule which deals with local travel, which is called typically called conveyance. So if the transportation or travel is within the city, it's again tax free as a conveyance. If it is between two stations, it is travel, but essentially both are on the same footing. Then there is a transport allowance. If the fixed allowance is given, irrespective of the amount actually spent, and then transport exemption can be given to transport allowance, but the condition now attached to this is earlier it was open for all, but sometime back it got restricted to some disabled category of persons. Now, an interesting thing here is this transport allowance is meant for commuting between office to home and home to office. If such an allowance is given to a normal person, it is presumably a taxable allowance because there is no specific exemption for that. But contrasting it with section 17, there is an explanation in section 17, which is the last item on your screen. It says that if a vehicle is provided to employees for commuting between office to home and other official locations, then the cost incurred on that commutation is not a perquisite. Now, this is slightly in contrast or incongruency with the transport allowance, because transport allowance is restricted to disabled persons, but the vehicle usage of vehicle is open to all. So conceptually, it makes sense if the law is amended to provide allowance benefit also to all, because then this incongruency will be resolved. It makes no logic that if the employer incurs on transportation of employees from home to office and etc., vice versa, that is not taxable only if the employer maintains the vehicle and allows its usage. But if he gives an allowance and employee himself decides, then it is taxable. I mean, does not stand to strong logic, but that is how the law is. Then there is an entry in section 1014 rule 2BB. Say employer gives a helper allowance of 22,000 and the employee incurs on two counts. He pays to his housemaid 8,000 and driver salary 14,000. Can he claim this exemption? Because section 10 clause 14 talks about helper allowance. Rule 2BB rather talks about helper allowance. Section 1014 is the foundation section. If you see, the rule 2BB says the allowance for engaging a helper in performing office duties is what is exempt. Though people claim exemption and by producing receipts from housemaids also, it's not being scrutinized to that detail because small amounts and at an employee level almost impossible to investigate to make those scrutinies. but technically this is the situation that it is meant for those helpers which are engaged in performance of office duties. Now, driver may be engaged in helping on office duties for his regular travel from one place to another place for official purposes, including, and this may include travel for personal purposes. That's very much possible practically. So, technically speaking, since the law says it is the expenditure incurred wholly necessary and exclusively in performing office duties. So section is stricter than the rule. Rule is simply saying that helper should be engaged in performance of office duties. But we read it along with section, it gives a stronger impression that not only that, the expenditure should be wholly necessary and exclusively for performing office duties. So personal travel should not be exempt on that count. but same driver being used for both the this thing, there is no way for the department to scrutinize these things. So practically, a lot of things are prevailing, but we should know technically what the law is. Another very important and interesting element of education cost. We'll take a look at what the law says first, and then see how it will apply to certain situations. See, education is a very important element for any economy, and therefore there are, I think, tax concessions granted in relation to that. Section 10, clause 14, read with rule 2BB, clause E, exempts any allowance if it is granted for encouraging academic, research or training pursuits in educational and research institutions. So if an employee is given an allowance for spending in any educational institution or for spending in any research institution with a view to pursue any academic course or a training course, then that allowance is exempt to the extent is actually suspended. So though the language of the rule is not very clear, but it gives a strong impression that this is meant for employee himself. If the employer gives for employees on further education, then the allowance is non-taxable. On the other hand, if you see section 17 subsection 2 defining the perquisite includes a clause which says that if the employer meets an obligation of the employee, any payment by the employer with a view to meet the obligation of the employee is a perquisite. So suppose the employer pays for the school fees of the kids of the employee. That will be an example of an obligation of employee met by the employer. I'm not reaching to any conclusion that that is perquisite. I'm just giving an example. We'll see whether it constitutes perquisite or not. Now, there is a rule 3, sub rule 5, which provides what is the cost, what is the value of the perquisite. It says the value of the perquisite in case of free or concessional educational facilities for any member of the employee will be cost incurred by the employer. It again, coupled with the 17.2 and the example I took, gives an impression that if the cost of the education of the kids of the employees is met by employer, then whatever cost is incurred is perquisite value in the hands of the employee. Now, with this background in mind, let us take a look at this fact. Mr. Intelligent gets an academic allowance from his employer, which he spends on buying magazines, books, and travel in relation to undergoing a skill enhancement program from, there are various kinds of private institutes today, for example, Upgrade, Simply Learn, LinkedIn Learning, etc. Whether this allowance is exempt on spending on these activities. The question is whether Mr. Intelligent will get exemption under section 1014 read with rule 2BBE on this education allowance or academic allowance. Now, as we saw, rule provides for exemption for any academic pursuit in educational institute. The question that arises is whether these kind of organizations, do they qualify to be an educational institute? What is essentially an educational institute? There have been various judicial precedents trying to define or explain the meaning of the word educational institute, though in the context of different provisions, but equally applicable or relevant here. For example, in the case of Lok Shikshana Trust, Honorable Supreme Court said that the process of training and development of the skill, knowledge, mind, and character of student by normal schooling is education. And educational institution is any organization which imparts systematic training for imparting knowledge, skill, etc. Honorable Delhi High Court added little more flavor to this. It says it should be an institution which is done in a systematic manner. There should be regular classes. There should be vacations. There should be attendance requirement. There should be enforcement of discipline. So it did too many things into this. And in terms of who can be a student is, there is no age bar. There is nothing as far as who can be a student. Any person who is trying to learn skills and who is trying to upskill himself by by taking further qualification, experience, and knowledge is a student, which includes a research associate also. So the thing which is to be seen is, I'm not concluding whether any of these organizations, which is for example Upgrade or Simply Learn, etc., will be qualifying this. But what we are trying to share is what are the parameters which have to be applied to determine whether they will qualify to be educational institution. Now, in terms of the rigidity which is let down by Honorable Delhi High Court, that should be attendance and vacation requirement. There are other judgments also which say that no, it is not necessary to be a classroom teaching. It is enough that some skill training, etc., is imparted. We can take a liberal view also on that. So, applying these parameters, one should examine in a particular fact pattern whether these will qualify to be educational institutions. Now, the law on that also says that not only the fees but also the cost on the allied costs are also exempt. So if a person is undergoing a financial course and he's purchasing finance related magazines, it may be qualifying for that exemption. But if he's purchasing unconnected books, that cost will not qualify to be this deduction or exemption. Now take another case. We're still continuing with the same topic of taxability of cost of education. There's a company Illuminating Limited which pays 2.5 lakhs to bear the school fees of its employee, Mrs. Saraswati. So whether this will be taxable purpose. So what we have read so far is, if it is for the employee himself, it is exempt as allowance. If it is for the member of household or members of the family, it is taxable perquisite, and cost of that is the perquisite value is whatever is the expenditure incurred by the employer. The thing is, this is not the all law. There is one more statutory provision which is very, very less explored, very, very used in a very less and not very famous, is section 10 clause 16. This section 10 clause 16, very short section, simply says exemption, the income which will not be forming part of total income is, for example, scholarship granted to meet cost of education. So who can give scholarship? No parameter, anybody can give. To whom it is to be given? To anybody. This section does not say if given by X to Y. It doesn't say it can be given by unconnected person, it should be given by some charitable organization. No, nothing. It simply says scholarship given to meet cost of education. Anybody can be giving, anybody can be receiving. The exemption is quite open-endedly worded. The question arises is, in the given facts of the case, the 2.5 lakhs rupees paid by Illuminating Limited to Mrs. Saraswati, is it salary, perquisite, or scholarship? That's a very critical and important question. Now we noted what is perquisite. We noted that Rule 3 provides for taxing this. There is a specific entry: if you meet the cost of education household, it is perquisite. Then will it still qualify to be scholarship and still exempt? What is scholarship? Scholarship is explained to be any money given as a grant to enable a student to pursue his studies in a school, college, or university. So it's any kind of gratuitous payment to any person to meet the cost of education. That's the simplistic definition, which is quoted in one of the judgments also. And this judgment says that even if this payment constitutes perquisite, even then it will be exempt under section 1016 because it is also scholarship. Very interesting reasoning given is section 10 seeks to exempt those receipts which are otherwise income. If something was not an income at all in the beginning, what is the need of exemption? But exemption makes sense only because it is taxable otherwise. How it is taxable? It's a perquisite. Because it is perquisite, it is taxable. And because it is scholarship, it is exempt under 1016. Interesting though, but it gives rise to more questions. If every such payment is exempt under 1016, then what is the fun of first treating it to be perquisite? Will such an interpretation not make the entry in rule 3 redundant? Will that entry in rule 3, which says it will be taxable as perquisite, will it carry any meaning at all? We know that any interpretation which results into redundancy of any provision is to be avoided. Meaning thereby, there should be some situation at least in which rule 3 will say it is perquisite taxable, but it should not be held as exempt under 1016. So how to distinguish the two? The solution is also given in the judgment, which says that it is scholarship because it is gratuitous. Now, if the payment is mentioned in the appointment letter or in the salary slip or in the CTC, if it's a part of the agreed salary as a cost to the company, then, and it is a right of the employee to receive that, then it is perquisite taxable. It is no longer gratuitous. The moment it ceases to be gratuitous, it is not scholarship. So therefore, if it is structured in a fashion that it is integral part of the salary, employee has a right to receive, it becomes perquisite, ceases to be scholarship. If it is given gratuitously, it is exempt as 1016 scholarship exemption. Now, there have been some cases where the recipient did not have any other remuneration coming from the payer. And he was working for example, the doctor was, or the research associate was working for a hospital, and the hospital gave the research associate only one sum of money, which is called as a money for meeting further education in some other institution, in pursuant to the in relation to the research he was doing. So there was question whether this whole sum is salary or scholarship. In that case, the payer of the money gave a certificate that this is not for the services he is rendering to me, it is for the meeting his cost of education. So the court relied on that evidence and said it is scholarship. So therefore, that can also be an important piece of evidence. Conjunction with, it is not a part of your emoluments as a CTC. On separately, the employer gives in writing that it is not on account of services rendered, but as a gratuitous payment. That will help in the case. One more extension to that. Suppose the company gives a scholarship of 2.5 lakhs, and actually the amount spent is only 2,20,000. Whether whole of it will be exempt or only to the extent it is actually spent. Now, as we see, the section 216 simply says scholarship is exempt. It doesn't say to the extent actually spent and all. So the courts have held, these two judgments I could see, that it is not necessary to inquire as to how much is actually spent. What is to be seen is what is the purpose for which it is given. The moment objective and purpose are qualified to be scholarship, no further investigation is required. Then whether there is a common practice of giving uniform allowance. Now, say there is a company which provides a mandatory dress code, whether purchasing clothing, the cost of clothing to meet the requirement of dress code will also be exempt as a uniform allowance. Section 1014 with rule BB 2BB gives an exemption for uniform allowance. The uniform has been defined in this Gujarat High Court judgment to mean that there should be a precise instruction as to nature of dress, color, design, so as to achieve uniformity in the entire workplace. Simply having a dress code is not enough. If it is actually an identical kind of dress, a uniformity of color, design, etc. is there, only then it will be uniform. Take a case of advance salary versus loan against salary. Say there is a company which gives its employee a salary of 7 lakhs per annum, and in addition it is given advance of salary of rupees 3 lakhs. Whether entire 10 lakhs is taxable in the same year or only 7 lakhs is taxable. Now we all know that salary is taxable on due or receipt, whichever is earlier. That's the common notion we all have. So the answer to this would be obviously entire 10 lakhs is taxable. But the question connected to is, would it make a difference if 3 lakhs is not paid as advance salary but as loan? Now, an important thing two things to be borne in mind. Number one, if loan is given without interest, then rule 37 says the interest saved by employee is also perquisite. So if we are projecting it as loan, are we ensuring that perquisite value includes the interest element saved by the employee? How that is calculated is, we take SBI PLR rate minus the interest, if at all, paid by the employee, is the taxable perquisite. So if we want, if somebody believes that the transaction is in the nature of loan, then ideally perquisite valuation of the employee's salary should include a taxable component amount of interest saved. But another question which needs to be kept in mind is whether it is really a loan. One may want to say, and one may even sign an agreement that using the nomenclature loan, but the real character will not be determined by the agreement terminologies, but by the substance of the transaction. How a loan is differentiated from advance, a very important parameter is loan is typically repaid in monetary terms, while advance is adjusted against the transactions otherwise undertaken. And in case of salary, what I have seen so far in practice is it is invariably adjusted against the salary. So therefore, very difficult to say it is loan, and taxability therefore should ideally arise at the time the payment is given. You want to characterize as loan or advance salary, it will be very difficult to canvass a case that it's a loan. Though if you have included in the taxable perquisite the interest element saved, it will strengthen the case, but not a foolproof manner. So there are judgments which I have referred to in the slide, which lay down the parameters as to how to distinguish between loan and advance. Now this is a simple case relatively, wherein an employee, in addition to salary, also receives commission, and typically the commission income forms part of substantial part of the income, and employees sometimes incur expenditures also in relation to that. The question arises whether commission can be separately brought to tax under PGBP income. Our thinking on that is, it is not possible. Once an employer-employee relationship is established, then every receipt for anything done is a salary only. Especially here, he is a sales executive, marketing executive. He is doing the same function to earn the basic amount as well as commission. So therefore, it will not be possible for somebody to say that it is separately taxed as BGB income. Now, very, very briefly, I'll just touch upon the taxation of employee stock options. There are 4 stages in an ESOP scheme. In employee stock option plan, the first stage is grant of this option. When a company announces the scheme that on so and so parameters after so and so time on meeting certain conditions by the employees, it will allot shares to the employees, X number of shares to depending on the cadre, etc. So when the scheme is announced and the people become eligible to work on that, that's a phase of grant. Then there is a period during which certain milestones need to be achieved by employees, or maybe on passage of time, employees will be entitled to those shares, which is called vesting period. So during the vesting period, it could be 2 ways. Maybe the scheme says just on a temporal time, on lapse of say every year, some 200 shares will vest in the employee, which he will be entitled to exercise after end of say 4 years. So it will be temporal based scheme, or it will be milestone based scheme that any employee who consistently achieves a particular performance level will be entitled to X number of shares. And after the vesting period is over, the employee becomes entitled to exercise the option and the shares get allotted to him. And once the shares are allotted, he is entitled to sell. So the taxability in the hands of employee occurs at the time of exercise, at the time of allotment of the shares, and the value is taken which existed on the date of exercise of the share, exercise of the option, based on whether the shares are listed, then listing the listed price value, or unlisted shares. Simplistically, the merchant banker will provide the valuation certificate for the shares, and on transfer of the shares, the incremental value will be taxed as capital gains. So say suppose in year 1, the option was given to employees that you will be entitled to purchase 1 share for 100 rupees, irrespective of the value it achieves at the end of year 3. And year 3, the employee exercises that, and on that date, the value of the share is 300. Then 200 differential will be taxed as perquisite. And if the employee later sells it, then say it sells at 350, then incremental 50 is taxed as capital gain. I'm not getting too much into the mechanics, but on a broad scheme of the things, this is how it works. So as far as employer is concerned, he will get deduction year on year basis based on the estimated value of the estimated cost of the shares. So there's the SEBI regulations provide for valuation of these costs on the basis of Black-Scholes formula. The various judgments of different courts saying that the employee can account for an expense and claim that as a revenue expenditure on a year-on-year basis. So the vesting or the exercise is to happen, say for example, on the end of year 3. So the employer estimates that the end of year 3, my value of my share may be say 275 rupees. Employee will give me 100. So 275 minus 100, 175 is going to be a cost overall during the period. This is not how it is worked. It is worked on the specific formula, but I'm just giving a hypothetical example. So on a proportionate basis, that cost will be spread over 3 years and the expenditure will be claimed. The fact that this expenditure is not notional, not capital, not arbitrary, etc., have been dealt with in the various judgments, and including Karnataka High Court judgment, and say that it's a deductible cost. So the employer will start claiming deduction from year 1. Employee will pay tax on year 3 on exercise of the option, and year 4 when he sells the shares. Now there is, especially in the hands of the employer, the deductibility, despite so many judgments being in favor, is still being debated by the department or relying on the judgment of Supreme Court in the case of IMCO Limited. So what this judgment of Supreme Court in the case of IMCO Limited has held is that if shares are issued to acquire an asset, then the expenditure in acquiring that asset or whatever it is capital in nature. So in that case, a technology was taken on license by the company by issuing shares. So the department is applying this judgment to say that whatever you incur expenditure on, if you are meeting the liability to pay for the expenditure by way of issuing shares, it is capital in nature. So this bottleneck still exists, which we need to cross in due course of time. But as of today, there are so many judgments in favor. No, some people believe that this ESOP options give a lot of tax deferral in terms of the employer will start claiming the deduction from year 1, but the employee will offer to tax an income at a later point of time. But another thing which needs to be borne in mind is, before one uses it as a tax planning tool, is that there may be a tax rate differential. The company may be paying, because of some special schemes, tax at a much lower rate, and the employee would be paying tax at a regular rate. So in such a case, because of differential tax treatment, it may not really work to be a tax planning tool. But yes, it is still continued. It has always been a remuneration tool, or is a tool for compensating the employees or remunerating the employees. It's a payment planning tool, and that is how it should ideally be used. Now, another thing which is in the last item on the screen is cancellation of the agreement before the exercise of the option. Now, this is very interesting. So what happens is, the company has announced a scheme, the employee is acting on it, vesting period is over, exercise time is due. If the employee exercises the option, say the share price is 300, the market value of the share is 300, employee has to pay 100 rupees. So 200 differential will be taxed as perquisite. Or say example that it is the employee, it's free of cost. He has met the things and he is entitled to purchase the share free of cost. So entire 300 is perquisite value, which is taxable at a normal rate. What happens in some countries, what they have tried is, instead of exercising the option before sometime before the exercise date, or even during the vesting period, they will terminate the agreement and compensate the employee by making payment. In that kind of an arrangement, it will not satisfy the requirement of being a perquisite. It will attain the characterization of a capital gain, because the employee has a right to receive shares. He's foregoing that right. He's kind of transferring that right or abandoning that right, and cancellation or abandonment of right would constitute extinguishment of a capital asset. So whatever he will receive will be capital gain, and if the period is of long-term nature, it will be long-term capital gain at a much lower tax rate as compared to regular perquisite taxation. So that's another kind of planning which some companies are adopting. It is yet to test the times of the court, but looks a good proposition to think about. No, medical cost is also another important cost, which sometimes, the employees in a situation where they have to incur cost and the employer gives a financial aid for that. So in this case, say for example, there's a company who has borne the medical bills of the employee for his surgical operation of the kidneys, for example. Whether this cost of treatment is taxable in the hands of the employee is a question. Now, if you see section 17 says to start with that any obligation of employee met by employer is taxable. Then there are exclusions in section 17 in relation to specific medical expenses. So if the expenditure is in government hospital by the given by the government organization to its employees, then it is exempt. Or if the expenditure is in respect of an approved hospital for prescribed ailments, and this kind of operation does not fall into the prescribed ailments, unfortunately, therefore, this will not be covered by this exemption. The third exemption given is in relation to COVID related ailments. So anything over and above these three exemptions is a taxable perquisite in the hands of the employees. That is somehow the not so happy situation of the provision so far. Now, moving on to a perquisite in the nature of rent-free accommodation, an interesting case study came to light. This say there is a company and gives its employee a salary of say 75 lakhs per annum, and the company has also taken on lease an accommodation and pays for rent of 75,000 per month, and this accommodation is given to its employee as a rent-free accommodation. Now, the perquisite valuation rule says the rent-free accommodation perquisite valuation is either 15% of the salary or actual rent paid, whichever is less. So in this case, the rent paid is 75,000 per month, which is less than the 15% of salary, will constitute the taxable perquisite in the hands of the employee. Say suppose we have already seen this in some other case that if interest-free loan is given, then the perquisite valuation will be based on SBI PLR rate minus the interest paid by the employee. So just for ready reference, in the ready rectors, these rates are given depending on the CIBIL score, which nature of loan. Then the rates for the SBI PLR can be picked corresponding to the relevant nature of loan and CIBIL score. Now, if the entire thing is structured slightly differently, say for example, in this case, there is Mr. Creative who works with Innovative Limited, and the salary is same 75 lakh per annum. This company has taken on lease and accommodation, same kind of accommodation, but the rent is 40,000. The rent is low, 40,000, because not because the space is different, but because this company has given a lease premium, a security deposit of 60 lakhs. So it's a cash rich company which can give security deposit of 60 lakhs and arrive at and negotiate a much lower rent. In this case, the rent paid itself is less. The question is whether the perquisite valuation will be actual rent paid by the company, 40,000 rupees per month, or whether the notional interest which is lost by the company will be added to the perquisite value. Now, if the loan is given to the employee, we know that rule says the interest saved is perquisite and SBI PLR rate has to be adopted. What will happen if instead of loan given to employee, it's a kind of security deposit given to the landlord for achieving at a lower rental per month? So there is interestingly a judgment in the case of Shankar Krishnan in the Bombay High Court, which said that the notional interest cannot be added to the perquisite value. So in this case, the perquisite value will be based on actual rent, which is much lower. The other example is of car perquisite. This works very interestingly. If you see this example, for there's a gentleman, Mr. X, earns a salary of 2 lakhs per month, and the lease rental of the car he pays is 20,000, 15,000 he pays to driver, and 3,000 he incurs on fuel cost. So around 38,000 he spends on usage of the vehicle. He earns 2 lakhs. His whole salary will be taxable. There is no, he cannot claim any of these expenses against his salary. But take a case, another case, instead of giving 2 lakh salary, he's given only 1,62,000. The employer pays for car leasing, the employer directly pays for car to the car leasing company. The car is taken, the lease is taken in the name of the employer himself. So it's between employer and the financier. The employer pays for the lease rental. Employer pays for the for the driver. It engages an entity. The entity service provider provides a driver, and it pays 15,000 per driver to that entity on for the service of driver. And the employer also bears the cost of running and maintenance. So if it is structured like this, the taxable salary of the employee would be 1,62,000, which he receives per se as monetary terms, plus perquisite value of this entire thing. The perquisite value of usage of vehicle, which is chauffeur driven, is provided in Rule 3, which for a high-end vehicle is also 2,400 per month for the vehicle and 900 per month for the driver. So see the quantum of saving per month which can be achieved by the car lease model if it is used as a perquisite, as a component of the salary. Now again, a common practice is to give gift vouchers. So annually, the rule provides that gift vouchers up to rupees 5,000 given to the employees are not taxable as perquisite. But an interesting question in this regard is, what if in the appointment letter on the or in the salary structure, this 5,000 gift voucher is mentioned as a part of the total remuneration? The moment anything is mentioned in this appointment letter or in the emolument document, it ceases to be voluntary. If it ceases to be voluntary and becomes a right of the employee to receive, it ceases to be gift. If it is not a gift, it will not qualify for the clause which exempts gift up to 5,000. So the small amount, it seems to be small amount, but we will see it is when at the company scale, it is given indiscriminately to all employees, and there are tens of thousands of employees in the company. The small amount gets magnified into a huge number from a company's perspective. Take a connected case. On the marriage of an employee, a gift of 21,000 in monetary terms is given to the employee. Interpretation of this clause, which says 5,000 is exempt, is involved here. The question is whether entire amount is taxable or only 16,000 is taxable after exempting the 5,000 of exemption provided in the clause. The way this clause is worded is similar to the clause pertaining relating to cost of education. We have seen the detailed examination of the provisions relating to cost of education. There in one element which we have not so far seen is in the clause which deals with cost of education. It says if the cost of education provided to the household of the members of the employees is up to 5,000, then the value is nil. Now, there was a Delhi High Court, the Punjab Haryana High Court in the case of Delhi Public School. There in this clause of education cost was involved. The employer had given free education to the wards of the kids of the employees, and the cost of education was included in the perquisite value after giving a deduction of 1,000 rupees. So say if the cost of education was 5,000 per child, the perquisite value was included by deducting 1,000 from that. The court interpreted the clause to say that it is not a standard deduction. If the cost is up to 1,000, then it is not taxable, which means the moment it crosses that amount, the whole is taxable, is the interpretation given. Applying the same thing here in this context, the result is if this whole amount will be taxable the moment it crosses the exempt amount of 5,000 rupees. There is again one this in this rule 3, there is a clause relating to club membership fees. So if the company takes a corporate membership of a club and employee is allowed to utilize that, and there is an annual expenditure incurred on that, the rule says that the annual expenditure is taxable as a perquisite and the membership fees is not taxable. Connected point is the taxability of the subscriptions to organizations like gym or golf club. The question is it a taxable perquisite? Now there is a separate subclause which deals with health clubs. So primarily any club membership fees or subscription fees is taxable perquisite, but there is an exemption carved out for the expenditure incurred in relation to a health club for even the employee or any member of his family. So any health club or sports club or similar activities, if it is uniformly provided to all employees, will not constitute a taxable perquisite. Now, a question in this context is whether golf club will qualify to be a health club or a sports or a similar activity. No, I am not going to deal with this question. I'm just leaving it for all of us to examine if this necessity arises, whether golf is a sport. I did some working on this, but it's an interesting proposition to debate on. Another common element in the salary structure is payment for internet and mobile bills. So the rule in this regard is that there is no specific mention as such for internet. The reference in the rules, residuary rules, is that any other benefit or amenity which is not separately discussed, the cost incurred by the employer is the value of the perquisite. But then the provisor to the subsidiary rule, this residuary rule says that any expenditure on telephones, including mobile phones, is not a taxable perquisite. Now the rules are very, very old. That time the internet was a very, very rare thing, and nowadays we all use it very. I mean, without that, the life is not really possible. The rules have not been revised, and this does not specifically finds mention in the rules. So, do we claim exemption qua broadband charges Wi-Fi used at home is a question, especially because most of the telecom companies give a combined package of the landline phone and Wi-Fi broadband. So the practice prevailing in therein is it is being generally claimed as a tax-free element. The telephone on mobile has now got itself extended to an internet device. So there is a concept called updating construction. The rule is that if the technology evolves or the commercial world evolves, and the law was drafted years ago, is not strictly capturing the evolved technology or the commercial transactions, then in some subject to certain conditions, you can apply this rule of updating construction to say that this new thing should also get captured or covered by the provisions. For example, when the section used to say books of accounts, ledgers, etc., we all used to maintain hard copy ledgers. Whether the data maintained in the computer is itself a books of account, it's a soft data. There's no printout taken. Whether that can be also interpreted to be it's a books of account, that kind of thing courts have held that yes, it's also books of accounts considering the kind of technological revolution. So maybe we can support the exemption based on this kind of theory. Deepak, I think we are close to this. Maybe we'll extend it by a few minutes.
Certainly, sir, no issues.
Okay. So another case I want to touch upon is the when the employer provides assets for use of the employer household. Take a case where laptop which is owned or hired by the company is given to employees for use by family members. Now, if I mean, if it is used given for use by the employee himself for business purposes, there is no doubt about it. It's a basic infrastructure given to the employee to perform his employment related functions. But if it is given for use by family members, then what is the taxability of that? Uh, Especially if the ownership of the asset is not transferred. If it is simply given for use, ownership is not transferred. There is a rule in sub rule 7, clause 7 in rule 3, which says if the assets are given for use, assets are given for use for the household or members of the employee, then 10% of the cost per annum is the perquisite value. It rule specifically excludes laptops from its ambit. Then there is another rule which says the residuary clause says the value of the perquisite is cost to the employee for remaining things. So for any other benefit of perquisite, remaining thing is cost to the employer. Now, if we say that the transfer of the permission to use the laptop to the household, though it is not covered by rule 377 here, because it is specifically excluded, but it is covered by the residuary clause. It will be a little incongruent because cost of the laptop is 3 lakhs. It is given for use for some time, and that thereafter the employee leaves the company. He has used it for say 5 months, 6 months, or 1 year also. The primary rule takes about 10% cost, 10% of the cost annually. This rule talks about cost per se. To tax the entire cost in the hands of the employee, irrespective of the periodicity of the usage, does not seem to be making much sense. So understandably, this rule does not cover usage of the assets. That's the kind of understanding I can fathom from this rule. So looks like there is no specific provision to tax it. They would not have probably envisaged this kind of thing to be done. There is no valuation mechanism to tax it. And the valuation mechanism for general asset usage specifically takes it out. So therefore, it can remain tax-free is my understanding of the law. Take another case where an employee is given option that he can buy out a laptop after he has worked for a certain period of time at a very throwaway price. So that say that he has worked for 2 years. The employee has worked for 2 years, and after working for 2 years, when he's leaving the company, he is buying that asset for a throwaway price. What is the taxable perquisite in his hands? Now, the rule which talks about transfer of the asset, we have above we have seen is the rule which talks about usage of the asset without transfer. If on transfer, the separate rule says that cost of the asset minus X percentage of the depreciation kind of remaining value is the taxable perquisite. In the context of laptop specifically provides that cost, actual cost minus 50% per year will be the taxable component value. So if the 2 years has already been worked upon, then the cost of the asset will, the WDV will become nil. So 50% per year for 2 years, essentially after 2 years, if it takes away this thing, the taxable component will become nil. Not sure whether this can be used as a planning advice, but yes, it can be still a beneficial treatment. Another interesting transaction which people had been entering into in past at least is a key man insurance policy. So if a company takes an insurance policy in the name of its key managerial personnel, then a certain kind of tax treatments emerge in the hands of the employee as well as employer. So employer takes a policy in the name of employee, it pays the premium. The premium which it is paying is deductible under section 37(1) as a regular business expenditure. What happens in some cases is that at some point of time before the maturity of the policy, this policy itself is assigned to the concerned employee in whose name it was taken, or rather in the context of whose services it was taken. If the policy is assigned to the employee, at that point of time, as far as the employer is concerned, there is no tax treatment. But if the assignment doesn't happen and the policy matures, then whatever maturity proceeds the company receives is taxable under section 28 in the hands of the employer. And in the unfortunate event where the death or incapacitation of the person occurs, then whatever terminal benefits the employer receives is also taxable. So this is the basic scheme as far as the employer is concerned. Now, in the hands of employee, at the time of payment by the employer, there is no taxability because employer has taken, considering his or her own its own interests in mind, that if that there is a loss of that person because of death or incapacitation, the business of the employer will suffer. In its own business interest, it has taken the insurance policy. So if it pays a premium for that, it does not constitute any benefit of perquisite in the name of in the hands of the employee. But on assignment of that, say suppose prior to termination or prior to maturity, the policy itself is assigned to the employee. At that time, it will constitute a perquisite in the hands of the employee under section 17, and the value as determined by the insurance company as an assignment value will be the taxable quantum. After assignment, when the policy matures and the individual receives maturity proceeds, now say suppose the policy maturity value was 1 CR and on the date of assignment its value was determined to be 90 lakhs. That 90 lakhs when assigned to the employee becomes taxable perquisite in the hands of employee. And afterwards, when he receives 1 CR from the insurance company on maturity, the incremented 10 lakhs is taxable as a capital gains. That's the common practice, and department also accepts it. If in an untoward event, before the maturity, the death takes place, till some time back, that amount was exempt in the hands of the employee, just like any other insurance proceeds under section 10 clause 10D. Sometime back the law got amended and this has now become taxable in the hands of the employee. So post the law amendment, it ceases to have that attractiveness which it used to have earlier. But I am told that even today some of the insurance companies hard sell this product, but considering the change in the law because of taxability at the time of death, it ceases to be an attractive tool at all. Now, before we part with, just the last thing I wanted to discuss is in terms of the obligation of the employer when it has to deduct TDS under section 192, it has to deal with various exemptions available under rule section 1014, rule 2WB, etc., or other sections for LTC or etc. What is the kind of obligation on the employer to obtain the supporting evidences, to scrutinize them, to examine whether they are genuine or not. So if you see the law in that regard is there was a judgment of Honorable Supreme Court in the case of Larsen and Toubro, which said two important things. It said that is not the obligation of employer to collect and examine the supporting evidence. In that case, the employees were giving simply declarations that I have incurred this expenditure, this is my travel cost, etc. There is no evidence regularly being furnished. And the employer said, I don't have the wherewithal machinery to examine and collect so much of the evidences. They were simply working on the declarations. Thereafter, the section 192 got amended to say that the employer is obliged to obtain evidence. So the judgment of Supreme Court has been partially overturned legislatively to cast an obligation to obtain evidence. The remaining element of the responsibility to examine the evidence has still not been cast on the employer. So therefore, ideally, the employer definitely should obtain evidence. Prima facie, some kind of sanity check should be performed. But technically speaking, it is not the obligation of the employer to scrutinize things. But yes, if some things are glaring and very much apparent on the face of the things, then that should not be entertained with the employer before any kind of exemption, etc., is conferred on the employee while deducting TDS under 182. So I think with that note, I bring my presentation to an end. Thank you all for attending this, and thanks to the Karnataka State Chartered Accountants Association once again for giving me this opportunity. It's an oceanic topic. We have just tried to bring into discussion some of the things which we felt were most common and important. So with that note, I conclude the session. Thank you all.
So there are a bunch of questions. I'm sure we'll not have time to take up all of them. Maybe just one of those I found interesting. If you can spare a couple of minutes. So there's a query asking whether work from home allowance is exempt. Is any benefit, is any exemption available for a work from home allowance?
I said simply permission to work from home in itself is a benefit conferred. So on the top of it, if monetary benefit is given, what it is for? Is it for acquiring some infrastructure? Is it for regular stationery, table, desk, chair, telephone, etc.? So it will depend on all that. If it is for acquisition of an asset remains in the ownership of the employee, then it is not exempt. There is no, I don't see any provision for that.
Right, sir. With your permission, we formally conclude our today's session. I, on behalf of KSCAA, thank our speaker for the day, Shri Sumeet Khurana, for having consented for our program and having shared his expertise with us. Sir, we are extremely grateful to you for the time spent, which I personally am aware has been significant. We also thank our attendees for their overwhelming response to the program. It is their participation that keeps us motivated and working. Thank you all. The event stands concluded. Thank you.
Thank you. Thank you.